Welcome to the Application Lab. Today we are reviewing business ownership structures. By the end of this lesson, you should understand what these forms are, why they matter, and the key details to remember. Think of business ownership structures as different containers for real estate activity. The container you choose dictates who has authority over the property, how the tax burden is shared, and who is responsible for the financial risk. The simplest container is the sole proprietorship, which is a business owned by one individual. When one person or one legal entity owns property alone, the law calls this ownership and severalty. The owner's interest is entirely separate from all others. This one owner baseline is our starting point. Every other structure we cover is a different method of dividing that same control, taxation, and liability among multiple people. Partnerships increase the complexity by involving two or more people or entities who agree to operate the business together. In a general partnership, the partners are usually personally responsible for the business debts. A limited partnership functions differently. It has at least one general partner who manages the project and assumes the liability, while limited partners act as investors. These limited partners generally avoid personal liability, provided they do not participate in management. When partners hold title to real estate, they typically choose between two forms. Tenancy in common allows each person to hold a separate interest that they can sell or pass on. Joint tenancy, however, is defined by the right of survivorship. This means if one owner dies, their interest automatically transfers to the surviving owners. This distinction is what determines the property's future. While the partnership structure handles the business risks today, the title determines whether an owner's interest can be inherited or if it must remain within the group. A corporation is a distinct legal entity created under state law. It exists as an identity separate from the individuals who own it. Because the law treats the corporation as a single entity, it can own property in its own name. This means that even if a corporation has thousands of shareholders, the title is still held in severalty because the corporation acts as one single legal owner. Tax rules depend on the corporate structure. A C corporation pays corporate income tax, and then shareholders pay again on dividends, which leads to double taxation. A subchapter S corporation avoids this by allowing income and losses to pass through directly to the shareholders. Incorporating offers a shield against personal liability, but owners must select the correct tax entity to avoid double taxation from eroding the real estate profits. Limited liability companies and limited liability partnerships are flexible hybrid structures. They provide the liability protection of a corporation combined with the pass-through taxation of a partnership. Legally, the owners of an LLC are called members. When a group of investors pools their money for a specific project, it's called a syndicate. If the arrangement is a temporary project-based partnership between companies, it is a joint venture. Real estate professionals must be aware of securities laws here. If passive investors contribute money to a common enterprise and expect their profit to come mainly from the management efforts of a sponsor, the arrangement is legally considered a security. Let's test this with a scenario. Maya and Daniel are buying a duplex. Maya will own 70% and Daniel will own 30%. Daniel wants to ensure his share goes to his daughter when he dies. Based on what we've covered, how should they hold title? They should hold title as tenancy in common. This is the only structure that allows for unequal ownership percentages and permits the interest to be inherited rather than passing automatically to the surviving partner. Now for a rapid-fire review. These distinctions appear most often on exam questions. Property owned by one entity is owned in severalty. Joint tenancy includes the right of survivorship. Limited partners act as investors, not managers. C corporations carry double taxation risk, while LLCs offer liability protection and pass-through tax treatment. Mastering this framework, knowing who manages, who holds the risk, and how title is held is the key to solving any business ownership scenario you encounter. Follow the Application Lab for real estate concepts made simple.